If you've ever thought to yourself, I need to get started investing, I need to get my money working for me, and I know that the earlier in life that I can start investing, the better things are going to be for me in 10, 20, 30 years time, but I have no idea where to start, what to do, or how to do it. If that is you, then this video is absolutely for you, because in this video I am going to share with you what I believe is the easiest way to get started investing, and that is through index funds. So today we are looking at what are index funds and how do they work. G'day there, my name is Phil McGilvray. I am a financial coach, financial well-being consultant, and the founder of the Money Boss movement, where we make practical, life-changing financial education both understandable and accessible for everyday people. And today we are looking at index funds. What are they? And how do they work? And why are they so good for someone who is getting started investing? So let's start with a really simple definition of what an index fund is. An index fund is a type of investment fund that tries to match the performance of a specific stock market index, like the S&P 500, which is the top 500 shares in the US. Instead of picking individual stocks, it invests in all, or at least most, of the companies in that index. It's a simple way to invest broadly in the market with low fees. So we talked there about the S&P 500, but if you're in Australia like I am, it might be the All Ordinaries Index, which is the top 500 shares in the Australian share market. If you're in Japan, it might be the Nikkei 225, which is the top 225 stocks in Japan. So there are literally hundreds and potentially thousands of indexes out there that simply just track the top 500 shares, or the biggest 500 shares, or the top 200 shares, or the top 20 shares. There's all sorts of indexes around the world where instead of trying to pick and choose which funds are going to, or which companies are going to be the best performers, you just pick the whole lot in the index and take the average of the index. Now that sounds like a cop-out in terms of your investment performance, but history and research shows us that index funds will beat actively managed portfolios. So that is where you've got professional fund managers trying to pick and choose the best shares to put in an investment fund. Index funds will beat professionally managed portfolios at least 90% of the time. Okay, so let's have a look then at how an index works, and I'll give you a very brief description here using chocolate cakes. I love chocolate cakes, but if you think of an index, so the S&P 500, the Dow Jones, the All Ordinaries Index, the Nasdaq, which is the top 100 tech stocks and so on. If you take an index, basically what you're doing with an index fund is you're setting up a fund that exactly replicates all the different companies that are in that investment fund or in that index in exactly the same proportions. So if you think about a chocolate cake, you've got a chocolate cake, and let's just say you make it with the flour and the cocoa and the butter and the water and the sugar and eggs that you pop into that cake. You've got the cake. You mix it all up, so all the ingredients are in there, all the different companies are in there, and then the cupcake is like taking some of that mixture and just putting it in one of those cupcake patty pans and making a cupcake from it. You've got all the same ingredients in exactly the same ratio, you get the same yummy taste, same result, it's just smaller. And that's exactly what an index fund is. It's just a fund that has been made up of the exact same ingredients, exact same portions, with ideally the exact same results as the index. Okay, so if we have a look here at the Australian, so the ASX, Australian Stock Exchange, top 20 shares, these are the biggest companies in Australia, the 20 biggest companies in Australia, in alphabetical order, not in size order. And we can see Amcor, of the top, it makes up 1.62% of the top 20 shares. ANZ makes up 8.27% of the top 20 shares. BHP 11.36, Brambles 1.77, and Commonwealth Bank 12.84%. So you can see that each, even though it's the top 20 shares, they all make up a different proportion of that top 20 in terms of the value, because their value is different. Each of them is different. But when you have the index fund, it has the exact same proportions in the index fund. So a lot like, in the cake, all the ingredients are all there in the same proportion, whether it is a cake or whether it is a cupcake. Okay, same stock, same proportion, same result. Okay, this here is an example of an index fund. For instance, Vanguard has an index fund called the Vanguard Australian Share Fund. It holds the top 300 shares in the Australian share market. So that is what that index is made up of. If we have a look at BlackRock, has the S&P 500. So this is the top 500 shares in the US. And it has the top 500 shares. And you can see here most of these, even though it's a US stock market, are household name companies to us here in Australia for most people around the world. So you've got Microsoft, Apple, Nvidia, Amazon, Google, Meta, Berkshire Hathaway, Eli Lilly, and JP Morgan Chase. So you've got a diversified bunch of companies in there that are all based in the US. And if you invested into the BlackRock S&P 500, you would have all of those investments in your portfolio. Now, I just want to quickly share with you the 5 rules of investing that I give to all the people that I work with when I'm running my financial education sessions and my coaching sessions and so on. It is 5 simple rules that will keep you out of trouble and allow you to build long-term sensible wealth. And these are, we want to invest in quality investments, very important. Secondly, we want to invest with a long-term time frame. Now, I've got 7 to 10 years there, but obviously if we could go 20, 30 years, even better, because compound interest is by far your best friend when it comes to investing. Number 3 is to diversify, to make sure you've got a good diversification of investments in your portfolio. And the third one is we want to invest small amounts regularly. And the last one is we want to keep the fees as low as possible, because believe it or not, just 1.5% to 2% in fees will rob you of over half your return over 30 plus years. So you want to make sure that you're holding on to as much money as you can, which means keeping your fees really low. Now, the reason I tell you this is because when we have a look at an index fund, we can immediately see that an index fund is one. It is going to give us access to quality investments. So you can see here, this is the top 10 in the US. You can see they're all big household name shares. Immediately, just by investing in, say, the S&P 500 index fund or the Nasdaq index fund, we can get access to high quality investments. Secondly, it makes it easy to invest for the long term, because we just stick it into an index fund. We can stick it aside into the bottom drawer and keep money going into it on a regular basis. And we can sort of set and forget. We don't need to really worry about it too much. The third thing is it gives you an instant diversification. We've talked about that. We get the quality investments when we get a good diversification when we're investing in an index fund. Number 4 is that most index funds will allow you to invest small amounts regularly, which is exactly what we want to do. On the bookshelf behind me there, I've got at least 2 or 3 books on automating wealth creation process and how that dollar cost averaging, small amount, same amount, every single month investing into an asset. This is easy to do when you've got an index fund. And then, of course, index funds, for the most part, are very, very low in fees, because they don't have fancy fund managers trying to pick and choose shares for you and doing all the research. They're just simply saying, this is what the index holds, and this is the proportion they hold each of those companies. We're just going to replicate that. So that means that the fees can be kept very, very low. Let's have a look at some of the benefits. Now, obviously, I've just been through some of them, but let's have look at some of the benefits of an index fund. Firstly, instant diversification makes investing super easy. One index fund, and you could have as many as 3,000 different companies from all over the world in your portfolio. Index funds beat 90% of professional fund managers' performance. So why would you pay your professional fund managers all these fees to manage your investments for you if they can't actually perform most of the time better than me just investing in a very low-cost index fund? Fees are very, very low, which is fantastic. You can get down to like 0.1% or even less than that, which is excellent. That means that the impact of fees over time are going to be minimal. Easy access to the biggest and best companies in the world, and I just showed you that a couple of slides ago. You can get started for as little as $200. In fact, in some places you can do less, but you do just need to be careful that the fees don't become too big a portion of the money you're investing. But as low as $200, certainly with the Vanguard index fund platform, fantastic place to get started. You can get started, set up and start in as little as 15 minutes. I think for many people, investing, the biggest block to investing is just worried about how hard it is going to be. Platforms like Vanguard make it super, super easy, or Raise, make it so easy for you to get set up and get going and have a regular investment going in the background that you can just set and forget. And it's very easy to automate that investment process. I've created a video just a couple of weeks ago on what dollar cost averaging is, that process of just identifying how much money can I afford to invest every month. And then just every single month it gets deducted from your bank account and invested in your asset, into your investment fund or whichever one you've chosen. To do that is just such a powerful way to get started investing. Okay, let's have a look at the negatives, because I can't get away without talking about the negatives of index funds. First one is you don't get to choose which stocks you get to invest in. So when you choose this route, you're basically saying, I'm going to invest in whatever the top 500 shares are in Australia, or the top 20 shares are, or the S&P 500 in the US, the top 500 shares there. You do not get to choose which stock. You just have to go with the flow with whatever's in there. Secondly, you don't get to choose the proportions of which funds, how much is investing in each company. Again, the index funds, true index funds, will have to invest exactly the proportions that those companies are represented in the overall index. Third is that investments will fluctuate. Now, this isn't specific to index funds, but you're going to see a lot of volatility whenever you're invested in the share market. Now, I will say there are index funds too that aren't just shares. There's index funds, for instance, with bonds and fixed interest and all sorts of other types of investments that you can invest in. Again, just track those particular indexes. But if you're invested in funds that are in the share market particularly, there will be lots of volatility and you just have to put up with that. But with higher risk, there comes higher return. Okay, and the last thing here, more money. This is probably one of the biggest downsides of index funds. And we saw this a couple of slides ago. And let me flick back to that actually. Let me just go back to that. I just want to show you this because this is important. If we have a look here, you can see I talked here before that Commonwealth Bank is 12.84%. Like, it is such a big company. That means that whenever your money gets invested into an index fund, 12.84% of it, if it was, say it was the top 20 shares, would be put into Commonwealth Bank. Commonwealth Bank is now such a big company, and BHP 11.3. They're such big companies that a big chunk of your money will be invested in those. And that means if those companies have a bad hair day, it's going to drag down the whole index, which means it'll also drag down your investment. So sometimes you're chasing the biggest and best companies, but they won't always be the biggest and best companies, which means if they do start to struggle for some reason, it can pull back the market overall. But every day there's a rebalancing of this. History has shown us that index funds are one of, if not the best way to invest, especially if you're just a beginner and especially if you don't want to spend hours monitoring your portfolio. So this is, it's not something that I would worry about, but it's important that you understand it. So let's click back to here. Sorry. Oop, there we go. More money is invested in the bigger companies. So the question now is, well, how do I invest in index funds? So I believe there's really two ways to do this. The first one is that you can invest in index funds by going directly to Vanguard, who is the biggest index fund manager in the world. This is my preferred way of investing. Now, I'm not recommending anything. I don't have any links or connections with Vanguard, where I get paid anything for recommending them. This is where I've got my kids set up. This is how my wife and I invest directly through Vanguard index funds, simply because it is so simple to do, so simple to set up. They are, as I said, the biggest fund manager in the world. They keep their fees very, very low, and they exist for the benefit of their investors, not for corporate shareholders. So, which is a really, really good thing. Okay, the second option is you can invest in index funds in the form of an exchange traded fund, which is basically buying an index fund on the stock exchange. So if you have some kind of broking account, you can also invest in ETFs through the Vanguard platform as well, but platforms like Raise, then you have broking firms like CMC, IG Markets, eToro. If you've got a trading platform with them, you can buy index funds through them as an exchange traded fund, which simply just means that I am buying the index fund as if I would buy a share directly on the stock exchange. And then you've got broking platforms through the major banks. So I've only got CommSec and NAB there, but ANZ, St. George, I'm missing one, ANZ, St. George, Westpac, they all have their own broking platforms as well. So you can invest through them. I did create a video just the other day on exchange traded funds where I talked about ETFs and how you can invest in those there. So make sure you check that out as well. Okay, so please do not overcomplicate this. Getting set up with investments is no harder than setting up an eBay account and buying and selling things on eBay. Sometimes just because it's money and it's vesting, I think we overcomplicate things and let overwhelm kick in. And if you were thinking, well, Phil, you've just given me too many options, can I suggest that the best place to start is simply just to go to Vanguard? Now, that is not a recommendation. This is just financial education, but this is where I got my kids set up with investing. This is where my wife and I do things. You can see that there's like a button there, open an account here. There's a button there, open an account here. It literally takes 15 minutes to get yourself set up and going. Vanguard, as I said, is the biggest and most respected index fund manager in the world. You can see down here, you can get started for as little as $200. You see over here the low cost and an easy way to diversify. So they hit all the key points for the smartest and easiest way to get started investing. Have a lot of respect for them. Again, have no relationship with them. This isn't financial advice. I'm just saying this is where if you were starting out and you're a little bit overwhelmed, maybe this is the way just to simplify it. Okay, I want to finish off now by just saying this is Warren Buffett, who's the world's best known, smartest, most successful investor. And his advice is for small investors to put their dough in an index tracking fund because of their broad diversification and low costs. And he says here, this is very important, a very low cost index fund is going to beat the majority of amateur managed money or professionally managed money over time. So he believes that the smartest thing to do is just track an index. He also said that like when he passes on, 90% of his funds are going to go into the S&P 500 index fund, which is the Vanguard S&P 500, top 500 shares in the US. And he said, with that one fund, it offers instant diversification across all 11 market sectors and 500 of the largest US companies. He said that it eliminates the risk that comes with buying individual stocks, and it virtually guarantees profit over a long enough holding period. And this is a really big thing to point out here, is so often we get caught up in trying to pick the best investments, but time will show us that, and in fact, Warren Buffett is proof of this, is not the investments you choose, it's how long you're actually in the market. A huge part of Warren Buffett's success is that he's been investing since he was 15 years old, and he's now well into his 80s, maybe even getting towards 90s, but a very, very long time. And most of his wealth has come after the age of 70. So it just shows that the sooner you can get in, the better. Don't overcomplicate it. Index funds is easily the best way to go. Now, if this has been helpful to you, can I please encourage you, click the like button, because that helps my channel reach more people. And if you would like to have or see on a weekly basis more practical, life-changing financial education, then can I encourage you to subscribe to this channel, because every Monday and Friday I'm releasing videos with simple strategies and habits that could literally make $1 million difference to your future. So I hope that has been helpful. Click the like, click the subscribe, and I will see you in the next video.